Hey, everybody, Mitch Wilder here with the Ahead of the Curve podcast. And on today's episode, we're going to talk about S-Corps versus LLCs. Now, a lot of times, if you're starting a business, if you're new to business, or if you've been in business, you need to make some changes. And you look at it and you say, well, maybe I have an LLC now, or I have an S-Corp now. I'm trying to determine which is better for my business, and I'm trying to determine, if there's going to be tax advantages to having one over the other, right? If you have one of these corporation types, you're probably wondering, am I in the right corporation type? Do I have the right corporate structure for my business? And so today, Micah is going to help us to compare the S corp to the LLC and determine under which circumstances an LLC could be more beneficial or an S corp could be more beneficial. So, Mike, I appreciate you sharing this with us today. So, tell us a little bit about just the overview of an S corp versus an LLC.
Yeah. So this was one of the ones, this discussion is very specific to your particular circumstances. And also, when I was trying to think of how to outline this, a lot of the framework will depend on what your frame of reference is. So, at least for me, I think the broadest way and the easiest way to start is understanding where business income will default to.
So, what do you mean by
So,
that? Where it will default to?
So most types of business income they're considered what you called earned income.
Yep.
So if you've got sole proprietorship income, if you've got most partnership income, if you've got income from a multi-member LLC, all of that, the majority of the time is considered earned income, and that's subject to Social Security and Medicare.
Yeah. So when
So
and so earned income, just a quick definition is I worked for the income. I traded
yeah,
time
you
for
you
dollars.
worked for the income, so your W-2 wages and business income from your company will default to that unless you make a special election with usually an S corp or you can, in weird instances C corps. But for most small businesses, it defaults to earned income, which has benefits, but the major downside is that all of that income is subject to Social Security and Medicare taxes.
Right. Right. So with
So
an LLC, it defaults to earned income, everything subject to Social Security and Medicare taxes.
right, exactly. And again, there's weird caveats and exceptions, but that's the way it is the vast majority of the time. So if you're a small business owner starting up, LLCs have a lot of benefits because unlike corporations where you've got minutes of the board of directors that you have to keep up with, you have to do a totally separate tax return. You've got just more bureaucracy and compliance type things to deal with. LLCs have a lot more flexibility just across the board. And one of the really major benefits they have is that if you're a single member LLC, that defaults to what they call a disregarded entity. So, for tax purposes, legally you've got an LLC, but for tax purposes, you disregard the entity and we treat it as if it's just regular sole proprietorship, self employed income.
So the
So, the
so the purpose of it then is I have with an LLC, unlike a sole proprietorship, I have more corporate protection, but when it comes to the taxation, I'm we're disregarding the corporate status or the corporate protection in favor of just having a simpler tax structure.
Right, exactly. You get some and liability benefit, but it's much simpler for taxes than it would be if you had an S corp or a C corp or even a partnership return. So that's a huge advantage for people who are just starting out and you don't know if this business is going to go anywhere. And a lot of times you're doing these on shoestring budgets. So the last thing you want to do is be forking out thousands of dollars a year for accounting related and legal related things. So the LLC helps to simplify that. So starting out hugely beneficial. As you start to grow, that becomes in many situations becomes more and more problematic again because every bit of profit is subject to Social Security and Medicare, or until you hit the Social Security cap at like what is now around $160,000. So the first $160,000 subject to both, and then after that, you're still paying Medicare. So as you become more profitable, that becomes more and more problematic, and that's where the S corp becomes much more helpful and where it's tax advantaged.
So
Because
where
with the
so well so in the situation of I'm a small business, is there a certain income amount that an LLC is better, a certain size, or does it come down to, I have this small business that's my full time income, it's my full time job. I'm out doing the work. We don't have profit. I just basically keep what I make minus expenses and do 100,000 per year. Is that kind of the situation where the LLC becomes a good option, like simple 1-2 man show?
it can, but even in those situations when you've got a 1 or 2 man show, assuming that this is your there's always weird exceptions. If you've got a W-2 job and you're already capped out on Social Security, well, the savings on the S corp are less than, because all you're paying on it, the business profits, would be Medicare. So we're talking about both sides of Medicare are 2.9%, versus if you're doing both sides of Medicare and Social Security, it's 15.3%. So that arbitrage, if you're already capped on Social Security, the savings become less beneficial. So there's weird caveats. If real estate income isn't subject to Social Security and Medicare, so the S corp doesn't help you there. There's different exceptions to the rule we can think of, but for most people, once you're making around 50-ish thousand dollars profit in your business, and assuming you don't have these sort of exception and weird niche situations, around 50 grand of profit will often be where the S corp is going to start to make more sense.
Got it.
And
That's a
again,
good.
that
Yeah.
that assumes that we can pay what a reasonable salary is for you. There's about 100 different things that we could go into, but as sort of a back of the envelope, just general rule of thumb, that's a pretty good one usually.
Okay, well that makes it simple. And my experience with this is before you and I met, and I had been working with an accountant that was not very professional, didn't understand the in depth nature of tax planning and all that. My experience is I went through a period of my life where I had to start over, as you've heard the story. I had to start over, and the good thing about starting over is you've done it before, you know,
Hmm.
so you can move
Yeah.
quick and you know what to do. And so when I was in this
It's
period of
like
my
when you
life, I had to,
play a video game a second time, just
right,
blaze
you know
through
what to
those
look out
first.
for and you just breeze through the level. And that's kind of what this was is, I had to start over. But the thing is I was starting over in the same type of business that I was already in. And, and so, it was, I moved to a new area, met with a new accountant, and I said, hey, I just quickly set up this LLC because of circumstances I needed to, and I said I'm going to make 6 figures in this first year, and I need to make sure that this is the right corporate structure. If not, I want to throw this one away and change it. And they're like, oh yeah, no, that's great, that's fine. The problem was I came to him at the end of the year having hit beyond what my goal was, making over 6 figures, and they hit me with the surprise tax bill that I wasn't planning on. And it was
Hmm.
like, well, a lot of people say that we didn't expect you to actually do it in your first year, you know.
Right.
And so,
And
it's just I just got nailed with
hmm
maxing out those taxes much more than expected. And that's a
and
situation
that's
where
one of
it
the
can be
other
damaging.
sort of that's one of the we don't mention as much, but that is one of the other benefits of the S corporation, because if you are just a sole proprietorship, or if you've got an LLC, it's not taxed as an S corp. All of that self-employment tax, that doesn't hit until the end of the year.
Right.
So it's just whatever that profit is, you multiply it by the percentage, and then you're paying it. It's all getting generated at the end of the year. versus with the S corp, the only Social Security and Medicare you're paying is what you run through your W-2 payroll. So even if you have a much better year than expected and you've got a lot more income tax that you're having to pay, at least in that scenario, it's not this double whammy of, okay, well, your income tax bill is twice what we thought it would be, and we've also got this 20K surcharge on top of it that you had
Right.
no clue was coming.
Yep.
So for people who, especially clients who have a little bit more difficulty with cash flow planning, that's another benefit of the S corp, is that you have automatic withholding because you've got a paycheck generating.
Right.
So all these things are things you don't need the S corp to do, or at least the making those estimated payments on time. But it does automate some of it, and also and reduces the total liability at the same time. So if people can be forgetful, people hate taxes, it's the last thing they want to think about. It does help to just manage your cash flow automatically for you to some extent.
Right. Well, and I feel like this is something I probably should know, but an S corp is simply just a corporation with the S election,
Or an LLC with the S
or an
election.
LLC with so
An
because
S,
the S election is just that's the election of how
yeah,
it's taxed,
exactly.
right? But it can be on a C corp, which would then become an S corp, right?
Yeah, all an S
Um,
corp is a tax election. It's not a type of
that
legal
makes it a
entity
flow
or
through.
legal
Right.
distinction.
Right.
It is, you can have LLCs or incs or corps, or they can be they're those are entities that are electing to be taxed as S corporations.
Right. So the difference becomes the rules change a little bit about how it can be owned, right? Because like
Right.
you can't have an S corp owned by a C corp, right?
Right.
Because of
S
it being
corps
a
are
flow through entity. So an S corp has to be owned by an individual.
has to be owned by an individual. It can be owned by a certain type of trust, and or it can be owned 100% by another S corp,
Okay.
and it's also limited to 100 shareholders. So for a lot of situations, especially if you've got a company where you're going to be looking at different types of funding that you want to receive, or different types of partners, there's also restrictions to where it either has to be US citizens or permanent residents.
Okay.
So there are downsides to it in terms of not only the who can own it, but if you down the road decide to revoke your S corp election, you've got a company, it's doing great, and then you need all these shareholders, or you need to change the structure for one reason or another. There can be again, depends on the company and what all you have, but there can be some pretty significant tax consequences for then revoking that S corp election.
Right.
So, and it's something you really, really try to avoid. So you want to think about what the ultimate goal for the company is, and you want to think forward a little bit as well to make sure that the last thing you want to do is revoke an S corp election. So you want to
Sure.
think about that at the outset as well.
Sure. Yeah. And I think with like from what I've seen, in the instance where you've got a smaller operation, you're not planning on going public, you might become one of the larger companies in a local service area or something like that. There's a lot of instances where I think the LLC is really beneficial, because if you have the LLC that has the S election on it, and hopefully I'm right on this. If not, I got to go do some paperwork. but you don't have to be doing corporate meeting minutes,
Oh,
right?
well, that's
So
I won't
that's,
say
I
it's
mean,
every client, but
the
that's a
primary
pretty
reason why they would have that.
yeah. There's just a lot more flexibility inherent to an LLC in general, and that's why I don't remember when the Uniform LLC Act came around. I think it was in around the 80s, but that was the reason was to try to encourage business and make it easier, and not
Sure.
with nearly the compliance issues you have with a true corporation. So yeah, a very typical setup that we'll have for people is that that's the majority of clients, I'd say, would be LLCs that elect to be taxed as S corporations. And the other thing that's nice about that is that, let's say you've got a little side hustle that's making a little bit of money, the S corp doesn't make sense to you at that point, but you get the LLC set up, you get your tax ID, bank account, all this stuff. And then a few years down the road, all of a sudden you're making $70,000 a year. And we're like, okay, now it's time to be an S Corp. Well, if you were operating as a sole proprietorship that whole time, well, now you've got to set up a whole new company, get new tax IDs, get new bank accounts, all this stuff. If you've got the LLC already, all you have to do is send in a 4-page form to the IRS that says, hey, I want to be an S Corp now.
Right.
And your business, the continuity for your business is so much easier because that's really all you have to do in the majority of cases.
Yep. Yep. So when we look at, we've really focused a lot of attention on the LLC and understanding what the S Corp is. So just in summary, on the LLC, what is a list of the downside or the pitfalls of generally having an LLC?
Well, if you have an LLC, it's not taxed as, and I guess the distinction would be it's an LLC, it's not being taxed as an S
Not being
Corp.
taxed as an S Corp, right?
The huge downside to that is that every bit of the income is subject to Social Security and Medicare. So that adds up very, very quickly, especially if and we'll run through the scenario of if you're making $100,000 a year profit, if you've just got that taxed as a regular LLC, every bit of that is subject to Social Security and Medicare.
Every bit of the 100,000 that you made,
Every bit of
subject
it.
to Social
So that's
Security and Medicare.
15 odd $1,000 that you're paying. Versus if you have an S Corp and we give you and again, what a reasonable salary is another discussion altogether.
Sure.
But if
Yeah.
we're able to say that a $50,000 salary is reasonable, well, then you're cutting that Social Security and Medicare in half. You're paying closer to $7,500.
Right.
So for people with operating businesses that they're working in who are making a reasonable amount of profit, the S Corp, be it in an Inc. or an LLC taxed as an S Corp, makes a lot of sense for your average sort of mom and pop company that's making good profit.
Yeah.
So for that's what makes sense for the majority of people, because you can talk about instances where once you're making 7-8 figures, well, okay, maybe we look at a C Corp for some of these things, or you look at some specific kinds of trust. Like there's really advanced tax planning you can get into, but for the majority of people, that's what makes sense. But the downside to the S Corp is these limitations on the ownership structure. And for a lot of people, that's never going to come into play. You're just operating your businesses, you're
Right.
going no problem. But it is something
If
to
you bring on a
consider.
partner, it might be a spouse or a child, that's going to take over the business, or a brother or sister. It's not going to exceed that 100 shareholders
Yeah,
that live out of the country.
right.
you know.
And it's even just little things, like you'll sometimes have people who want to, join into a business, but they hold all their ownership, all their holding company is a partnership. Well, a partnership can't be a shareholder in an S corporation. So
Right.
then you either have to get new holding companies or you have them own it individually. So that's the thing, is that you want to look and make sure that the S corp does have a tangible tax benefit for you. Because the easy example is rental income. Rental income is not subject to, it's not considered earned income, so it's not subject to Social Security and Medicare. So there's really no reason you can think of that you would want a real estate holding company to be an S corporation,
Right.
because all you're
Well, in a
adding
real estate,
in are restrictions with no tax benefit.
right. Well, in most cases, like I don't think that real estate can even be owned by a corporation. I think it has to be owned by or it can be owned by an LLC. But I was thinking that real estate couldn't be owned by an S corp.
It can be. There's
Can
just
be?
no
Okay.
reason to.
No
They just
reason
don't
to.
do it because there's no
No
reason to.
reason to. Got it.
So you've got, that's the easiest example. You could also have, one thing we probably want to touch on is that when we're talking about all of the income being subject to Social Security and Medicare in an LLC, that's only if what you're considered what is a general partner. and that's a general partner for the tax definition, not the legal definition. But if you're a general partner, that's usually you've got signatory and decision making ability within the LLC. So that's most people who are
Who are in the
owner
LLC.
of a small business. But occasionally, you could have a business where you've got one guy who's running it, who's the general partner, and then they've got 10 limited members. Well, the income to the limited partners is not subject to Social Security and Medicare. So again, it's a kind of a niche situation, but you could think about someone who it's being run, the LLC, the partnership, or the LLC being taxed as a partnership is run by a doctor who has already maxed out his Social Security and always will, and all of the other partners are limited partners. So the S-Corp doesn't have nearly the same benefit because the only thing that anybody's saving money on is the doctor saving some money on his Medicare taxes because he
Gotcha.
already capped out Social Security. So still, the S-Corp in that situation, many cases would still be a better fit, but the benefit is markedly less. So if you're looking at exit planning, if you're looking at restrictions on ownership, any of the sort of downsides to the S corp, you just start to weigh that against what are now markedly more minimal tax savings from the S corp.
Got it. Got it.
But again, that's not a situation 99 people out of 100 will deal with.
Well, and I think that's why it's important to, we've talked about in previous episodes where, one, you need to initially put together your financial team, you know, and
Hmm.
those first two people, when you're starting up a company, when you're setting up a company, the first two people are the CPA and the attorney working together, right? And
Right.
you come in and you say, this is the company that I'm looking at starting. This is what our, what we're going to be doing, what type of service we're going to be providing or what type of products we're going to be producing. Um, Companies have this potential. This is where this could go in the future, right? That's what you as the business owner are saying. The CPA is going to say, this is, what you're going to run into from a tax perspective. The attorney is going to say, this is what you're going to run into from a legal perspective. The three of you together bring together what type of corporation you need to set up, right? And
Yeah,
so
absolutely.
that's
And
it's essential. And the thing is too is I just talked with a good friend of mine, and he reached out to me and was asking about this specific thing, which is one of the things that prompted us making this video. If you have set it up wrong, you're not doomed, right? You can make
no, not at all.
changes. You can make changes. It's just that what typically happens is that you don't make the change until it becomes a problem. You know,
Right.
that's what
That
it was for
any
me.
of these things you can fix. It's just a matter of if someone comes to me and they started the business 6 months ago, well, and the setup is just trash. Okay, that the business is in its infancy. It doesn't have a lot of assets. Typically, it's you sometimes you can just restate the operating agreement
Yeah.
depending on the particulars of the situation. But to what you're saying, a lot of times these issues will come into play either 10 years down the road or sometimes just once the tax year has closed and they finally go to their accountant and we realize the structure was just not at all
Wrong from the beginning.
what you need it to
Yeah.
be.
Well, and I think what happens is that years 1 through 3, the growth of the company is compounding, right?
Mhm.
And
Right.
the first year, you don't notice it. You're happy that you made anything. Second year, it's like, oh, we did I always joke and say the last thing that you want to hear is you want to get a call from your CPA saying, hey, you had a pretty good year this year. That's
Right.
never a good, never a good sign.
Yeah.
But that's usually what's happening is the tax year has closed. They talk to the CPA and they are going to be hit with much more in taxes than what they planned on because they didn't talk to the CPA or the accountant before the close of the tax year.
Right, and that's one of the things we'll talk about all the time is generally the importance of planning throughout the year, but the big thing being that once the year closes, we lose about 90% of our flexibility and the maneuvers that we can make.
Yep.
So it's something to where people need to plan with their account throughout the year and really talk to what you're saying. Hopefully this video is helpful and informational and educational, but part of the reason this is one of the few ones I felt like I needed to outline before was because so much of it is relative to what your frame of reference is and what is going on with that specific business. If there was someone coming to me who outlined, here's the situation, here are the owners, here are what we want to do, I can say with a reasonable amount of certainty, yeah, this is what you want to do and here's why. But when we're doing it for a broader audience, you have to talk about all these sort of random exceptions that could happen,
Right.
and you could watch this video or read a book or watch something like and be like, oh yeah, sure, I'm going to do this, but then you're one of the unlucky ones who falls into one of those exceptions, and you structured your business the wrong way. And that's not a minor, sometimes it can be a minor thing that you can fix, but it's not inherently a minor thing.
Yeah. Well, and what I experienced, and I think what we'll do is, like you said, this is a topic where we're trying to cover our bases, we're trying to provide educational value. I think what'll happen is that over time we will refine this topic a little bit more. And what would be
Yeah.
really helpful is if anybody's who's watching to this point, who's experiencing this or is going through this, if you put your questions in the comments below, that would be really helpful to us, because I think what we'll do is we'll probably at least, once a year refine and
Right.
distill this
Right.
video, because
Yeah.
it's such a big topic and it's so misunderstood. And it's hard for us to even, we've both of us over the years have gotten a lot of questions on this, me from the business strategy perspective, you from the accounting and tax preparation side of it. And it's just a big topic. It's difficult to know what to do. And I think that the key takeaway is, before the end of your tax year one, you need to be approaching your accountant or your CPA and asking them if you're in the right corporate structure. And if you don't get a detailed plan as to why you're in the right corporate structure, what they're doing is they're preparing your taxes. They're not tax planning.
Hmm.
And if they're not tax planning, then the fact of the matter is you're not optimized for your taxes, right? Because they're just preparing, they're not planning. If you talk to your accountant and they don't know how many kids you have and they're not up to date on that, and they don't know that you got married that year, and they don't know that you're looking at buying a house the next year, and they don't know that you have some big initiatives planned to grow your business over the next quarter, then they're not tax planning, right? And you're not tax optimized. So if that's not happening, then the odds are that we see it all the time. Your corporate structure could very well be wrong. It could be one of the things that is wrong and that is costing you money. And that's why, with what you guys do in your firm, where we're doing the quarterly meetings, and you're asking questions like, what are your plans for the next quarter? What are some of the things that you're doing in the business? And you've always been able to prepare us ahead of time for changes that have been made. Or we say, hey, sometimes it happens, especially in the economy we're in. Hey, past 2 quarters have been bad. Past 3 quarters have been bad, right? What do we do now, whether it's better than we expected or worse than we expected? That's the type of things that, if your accountant or CPA is not asking those questions, then you really do need to talk to somebody who is going to, and is going to not only prepare taxes but really help you to create a tax plan.
Yeah, I mean, 100%. Just we try to make this as one succinct as possible and as informational as possible, and we're a half an hour ish into this video, but we really are just scratching the surface, and this is of a super important topic, but also a much more like foundational topic. This
Right.
doesn't get into any super advanced strategies. It doesn't get into even just for the S corp itself, optimizing your salary. It doesn't get into the discussion we have on the pass-through entity tax election. It doesn't touch it, and those are again sort of anchor-ish strategies. That doesn't get into anything with just your general business planning, how you deploy cash flow, investments, anything like that. So
Right.
it is obviously we're biased on this, but a good accountant accountants can cost you or save you more money than most other professions can,
Right.
because it's so easy to a good account can save you a lot of money. A bad account can so not only cost you money, but so needlessly cost you money if
Yeah.
that tax planning
There
isn't happening.
there is nothing worse than an accountant who caught like to me there's just nothing worse than unnecessary loss of money.
Hmm.
That is just the to me it's one of the worst feelings. And it's I think I'd put it this way, like a bad accountant will cost you money, right? Will cost you money, will lose you money. An okay accountant will minimize your tax burden. But when we get into a good CPA, they're going to save you money. But here's the difference: is a great CPA will not only save you money, but they'll help you make money. And
Hmm.
that's what sets them apart. Is there's different levels of this, you know, and that's really key. I know for me, when we started working with your firm, I I had fears for years holding me back because I was like, if I hit these levels in my company, I don't know. Like I already was gun shy because of some experiences of paying more than I expected, and in some cases a lot more. So I was a little gun shy. I was like, man, I only grew that much. Imagine if I doubled that or tripled that. And seeing how you operate and seeing how your firm operates and having you guys at the helm of the tax planning, I'm like, pretty much the sky's the limit of anything I could want to do. I'm no longer worried because I know that one, we're going to have the quarterly meetings that helps me to know, like helps somebody say, hey, you're growing really fast. We need to make this change. Or I'm going to be able to anticipate this is a change that's coming down the road, you know, and that's the key difference. Is it just frees up your mind and removes worry of what could happen if with taxes that you don't know about. It frees that up and it makes it so you can focus on growing the business.
Yeah, 100%.
So, well, since we are at 30 minutes on talking about this topic ish, ideally in the future, I'd love to distill this topic down. And what's going to help us is people asking questions in the comments. I'd love to distill this down and see, how simple we could make it. My goal is the next couple times
Hmm.
we talk about this topic to get it down to like 7 to 10 minutes. I think it'd be great to have it that simplified, but that's not today.
Yeah.
So, but I appreciate all your insights on it. We'd love to have any questions below in the comments below. As always, if you're looking for your specific questions answered, we mentioned getting your specific questions, your specific set of circumstances answered. In the description below, we have some links to be able to help you, like to our calendar where you can connect with us and we can ask some questions and see how we could help you and make some recommendations to your personal circumstances. We'd encourage you to do that. And of course, we'd love to have you subscribe so you can continue to get just help through these videos from future episodes. So we're really excited to have you here with us. We appreciate you taking the time to watch this, and we will see you in next week's episode.